Okay, well, welcome back, gang. This is Chapter 3, Adjusting Accounts for Financial Statements. We're taking a look at an alternate version of Exercise 3.4 from the textbook on preparing adjusting entries. So it says, for each of the following separate cases, prepare adjusted entries required for financial statements for the year ended, date of December 31st. Assume that prepaid expenses are initially recorded in asset accounts. That makes sense. And that fees collected in advance of work are initially recorded as liabilities. So let's just talk quickly about that. Assume that prepaid expenses are initially recorded in asset accounts. So if they prepay for something like prepay for the rent for the full year, prepay for insurance for the full year, buy a piece of equipment that's going to last them for several years, that is all money that is recorded as an asset. And then gradually the adjustments are made as those assets are used up. We're going to reduce that asset balance. So assets have a normal debit balance. We'll reduce those or use up some of that asset by doing a credit entry. Now, as we use up an asset, the portion used up in the period is going to become an expense for the period. So anytime there's an asset that has a prepaid amount in it, to lower that, we'll lower it with a credit. And the offsetting debit entry will be to some expense account, like rent expense or depreciation expense or insurance expense, etc. So that's the first part. It says, and that fees collected in advance of work are initially recorded as liabilities. Okay, so let's say a customer comes and says, I want you to do this consulting work for me for the next year. I'm going to prepay you for the full year. And in the first month, have we earned all that money? No, we've only earned a fraction of that. When they give us that money initially, we're liable to them to do something in the future, so we record this money as a liability. We increase our liabilities with a credit. Now as we start to perform that work, the amount that we're liable gets reduced, so we'll lower those liabilities, those credit liability balances with a debit entry. So as part of the adjusting process, we're going to debit liabilities when we lower things on the liability account for work that's actually being done. So we debit the liability. Well, what's the credit going to be? The credit's going to then become some revenue account, like service work, for example. Okay, so that's the basic setup. Let's take a look at part A of the problem. It says 1/3 of the work related to $12,000 cash received in advance is performed in this period. Okay, so 1/3 of the work related to $12,000 cash received in advance. So that $12,000 cash received in advance, where was that likely going to be? And what's going to happen now that 1/3 of it's used up? So initially we credited the account called unearned revenue for $12,000. That's when we got the money. We're liable to do something. We're liable to perform these services for them in the future. So $12,000, determine what account balance should equal. Well, if 1/3 of the work related to the $12,000 cash received in advance is performed in this period, how much was used up then in this period? So it should be an $8,000 amount is left if 1/3 of the work related is used up, because 1/3 of 12,000 is 4,000. So 4,000 of the work was used up. So we're going to debit this unearned revenue account for 4,000. That leaves 2/3 or 8,000 that's not been performed yet. So we're still liable to perform that. So we still have that liability called unearned fee revenue. So the journal entry is we're going to debit the unearned revenue account for 4,000, and then we're going to make that 4,000 revenue for us with a credit as well. Okay, so that's the first transaction. Let's move on to B. Wages expense of 3,000 have been incurred but not paid as of December 31st. So step 1, determine what account balance equals. Well, is there anything in wages payable? No, there's 0 in wages payable right now. Determine what the current account balance should equal. Well, we know that at December 31st, it should be $3,000. So then to go from 0 to $3,000, wages payable must be increased with a credit for $3,000. So the adjusted entry is to credit wages payable for $3,000. And then wages expense will get the debit for $3,000. So wages payable, we had Have to realize this is an expense for the period, so we're definitely going to debit the expense, but since we're paying for it in the future period, that wages payable comes in play for $3,000 as well. Let's move on to Part C. Depreciation on the company's equipment for the current year is $8,500. Okay, so these guys, they've got some equipment. The equipment has a debit balance in the asset account right now. They're going to use up some of this equipment. So step one, determine what the current account balance equals. Well, right now they're not telling us that there's anything in the depreciation account, depreciation expense. So it's 0. Determine the current account balance should equal. Well, it should equal 8,500. So how do we go from a 0 depreciation expense to an $8,500 depreciation expense? Well, the adjustment's going to be, we're going to debit depreciation expense for $8,500. Now, we're going to reduce this asset, this company's equipment asset, by $8,500 as well. Assets have a normal debit balance, but we're not going to credit the asset account. Instead, we're going to credit the account tied to the asset account, its contra account called accumulated depreciation. So accumulated depreciation will be the contra account that's linked to the asset account where we'll credit it for $8,500. Okay, let's move on to D. The office supplies account had a $200 debit on December 31st of the prior year. During the year, $6,400 of supplies were purchased. A physical count of supplies at December 31st shows 500 of supplies available. Okay, so we got to put all this together. Let's put up a little T account here. Let me see if I can get my marker changed to a little pen. And we have a little T account. And for supplies, we know the supplies had a beginning balance of $200. We also know that during the year, $6,400 of supplies that was also purchased. So $6,400 was also purchased. They say a physical count shows supplies at the end of the year is 500. So the question then is, how much of supplies were used up during the period? So we can do this a couple of ways. You can do a little math equation. 200 plus 6,400 minus x equals 500 would be certainly one way to solve it. Let's move on and take a look at what the problem shows us. So first, determine what the current account balance equals. Well, we know there was unadjusted of 6,600. That's that 200 plus the 6,400. Determine what the current account balance should equal. Well, we know it should equal 500. So how do we go from 6,600 down to 500? Well, we're going to have to credit office supplies in the amount of 6,100. So 6,100 would be the amount of the credit to office supplies. So office supplies get credited for 6,100, and the portion of this asset called supplies that got used up in the period becomes an expense for the period called office supplies expense for 6,100. Okay, a little tricky again, but I think the T accounts are helpful in trying to solve when you have several bits of data here. Let's move on to E. The prepaid insurance account had a balance of $5,000 on December 31st of the prior year. So remember, last year's ending balance becomes this year's starting balance. An analysis of insurance policies shows that 900 of unexpired insurance benefits still remains at December 31st of the current year. And they don't say the current year, but that's certainly what's implied. So they have this $5,000 prepaid asset. They bought an insurance policy. They had $5,000 of balance left at the start of the year. During the year, they used up some of that insurance, prepaid insurance, as it becomes insurance expense. But they didn't use all of it. There's still a balance left at the end of the year of $900. So let's put a little T account up as well. We have insurance expense. It's prepaid insurance, $5,000. Shows that it has an ending balance of 900. We need to solve how much was used up during the period. Okay, let's look at the rest of the problem then. So determine what the current account balance is. We know what that is. That's the $5,000 we just did in the T account. Determine what the current account balance should equal. We know that should be $900 at the end of the period. Then how much was used up? Well, we're going to have to use up or credit entry of $4,100 to get that balance down from $5,000 down to $900. So the adjusted entry is then to credit. Notice we're on the right side of the T account, so we're going to credit prepaid insurance for $4,100. That's the entry we just did, credit. And now the debit's going to be to insurance expense for $4,100. Okay, let's take a look at part F. The company has earned but not recorded $800 of interest from investments in CDs for the year ended December 31st. The interest revenue will be received on January the 10th of the following year. Okay, so the company has earned but not recorded $800 of interest from CDs. So determine the account balance, what that equals. Well, we have interest receivable. Right now it's 0. What should it be equal to? Well, it should be $800. How do we go from a 0 debit to an $800 debit? Well, we have to debit interest receivables for $800. So that's the adjustment. So in our journal entry, we'll debit $800 interest receivable. What are we going to credit? Well, it becomes interest revenue. So here, even though we didn't receive the money yet for interest from the bank for our CD that we had, they owe us $800. That's how much we calculate for the terms of the certificate of deposit, but we didn't get the check yet. Since we didn't get the check yet, we're owed the money. We have an IOU to show that we're owed the money, and that IOU is called an interest receivable account. Now, even though we didn't receive it, because it was earned in the period, it becomes revenue in the period. So that's why we have to record it still as revenue for the month of December. Interest revenue is the appropriate account here. Okay, let's move on. So for G, the company has a bank loan and has incurred but not recorded interest expense of $1,400. That's for the year ended December 31st. The company must pay the interest on January the 2nd of the following year. So we got to take a look at some things here again. Determine what the current account balance equals. Well, we know that's 0 right off the bat. There's 0 interest payable. Determine what the current account balance should equal. Well, it should equal $1,400. How do you go from a 0 interest payable credit to a $1,400 interest payable credit? Well, we must credit interest payable for $1,400. So our adjustment is to credit interest payable for $1,400. And we're going to be expensing that amount out as interest expense as well. So in this problem here, we've got this loan. We owe some interest. The interest isn't going to be paid though for some time, but since that interest really occurred in this period, it needs to become an expense for this period. So we need to debit our expense account called interest expense for $1,400. Not reducing cash right now. Cash is going to go down in the future, but we have to still record that expense for right now, regardless if we're paying it out in cash in the future. It still is an expense for right now. We're going to pay it out in the future, so we're liable to do something in the future. That's why we have this liability called interest payable set up. Okay, so another set of hard problems for adjusting entries. Be sure you go back and take a look at these closely.